Worldwide Holdings Incorporated, or HLT, has a market cap of $21.89 billion, nearly 30% larger than its closest competitor, Marriott International. Um, this is a pretty interesting stance because there's not a whole lot of consolidation in the hotel industry. There's a few companies that do it, but honestly, Hilton is the industry leader. There's been some interesting rumbles about a joining up of Starwood and Marriott, but it kind of fell through, leaving Hilton still in the lead. This puts Hilton in a couple of interesting positions. First, it has the leadership, and so whatever it does, it can expect to be able to bring more clout than its competitors. But second, it's in the position of not being as nimble, perhaps. There's high expectations within the stock market for Hilton. It can't just turn on a dime like a smaller company might. This is one reason why the acquisition is a good idea. It'll make a division of Hilton that'll be able to keep up with developing things like the shared economy, more social networking, more processing like that. And so some of the strengths of Hilton are its name recognition and its reputation. It has a long history. It has a very loyal customer base, and it has a presence in multiple market and pricing tiers without competing with itself. Hilton has managed to master the art of offering several different types of hotel at different levels, different prices, different markets, and not interfering with each other's operations, which is going to, as we'll talk about later, make it really easy for it to consider an integration with HomeAway. Some of the downfalls are that this large size does make change difficult. The primary market of Hilton is the United States, which is great and perhaps limiting for future prospects. The United States market is obviously not growing as much as some emerging nations, but we'll talk about that in a bit. Hilton is somewhat overly diversified. Hilton has many different tiers of hotels to deal with, different sub-brands. It's sort of a holding company that owns a lot of different chains of hotels, and this might make it difficult for Hilton to focus on any particular one or particular market. Hilton doesn't really have a good presence in China, which is, kind of a big market just about to open up. Hilton has a new brand called the True brand, which is actually targeted at the younger generation at an affordable price. This might be considered competitive with the HomeAway acquisition, but we'll talk about how it's not in a bit. Some threats to Hilton are the economy. The hotel industry fluctuates pretty severely with the economy. So if the economy goes in the hole, then so do Hilton's revenues. But it still manages to retain profitability, but it can really put a crimp into any expansion plans. Hilton has several traditional rivals and non-traditional rivals. Home rentals, couch surfing, and room rentals are some of the examples of the non-traditional rivals, and that's exactly why we want Hilton to horizontally integrate into the new shared economy and the online space. From an industry perspective, travel is a popular pastime. Revenues from international tourists visiting the United States was expected to rise 4% in 2015. This isn't strange, it's normal for the hotel industry. This sort of growth is great in a large company, and it actually gives Hilton the cash and the clout to really consider an acquisition like the one we're putting forth. There's opportunities for business growth in Asia and Latin America. Traditional hotel partners can use asset-light strategies in which they expand into new markets without buying giant hotels, building whole new chunks of real estate, without spending nearly as much as it would take to build in a developed country like the United States or most parts of Europe. Short-term vacation rentals in particular are an opportunity for Hilton because strangely, they don't seem to compete with classical hotel offerings. Again, this has been a surprise for most of the people in the industry, but it also offers a really great opportunity. If Airbnb and HomeAway and companies like them are not competing with Hilton, then they're very similar to the modular sub-brands that Hilton already owns, which don't really compete with each other. The fully upscale Hilton doesn't really compete with the Embassy Suite, which is sort of more middle scale, and that doesn't compete with its new True offering, which is marketed at millennials. So between all those different capabilities, Hilton should be able to take advantage of the acquisition. We'll talk about HomeAway a little bit now. HomeAway is one of Airbnb's biggest competitors, based out of Austin, Texas, and it's the global leader for an online marketplace in vacation home rentals. HomeAway provides entire homes for rent as opposed to a room in a shared house, has presence in over 190 countries and has over 1 million paid listings. HomeAway is maybe not as recognizable of a brand as Airbnb, but it has a really great international clout, which Airbnb has seemed to focus a bit more on the developed countries. This gives HomeAway a lot more room for expansion and allows it to complement Hilton's weakness in developing markets and the China market. HomeAway was founded in 2005, has 2,000 employees, 20 offices. Its model is a subscription fee to have your homes listed, and the corporate valuation of it is about $120 million.